Look of the day though, thought we'd take a look at the Waypoint REIT. It's experienced a 5% net reduction in property value in the 6 months that ends 31st of December. Company has said that its portfolio of 402 properties has 25 properties currently under rent reviews. Net tangible assets per security dropped 8% based on the June 2023 valuations. Reason I brought it up, Mark Gardner, is that REITs have been absolutely smashed over the last 2 years, haven't they? In anticipation that there'd be massive devaluations in property, particularly commercial and retail. Here's Waypoint, actually come and done one.
Yeah.
Down 5%. Not quite the 30% discount they're all trading at.
Yeah, look, this one's at around about a 16%. It's super solid because it's got those triple net leases, so it just owns the land. Everything above the land is basically the responsibility of the tenant.
So these are convenience stores and service stations. And things like that,
but they don't own the building. They don't service the building. They don't do anything else, but own the premium spots that they're on. So it's a pretty simple, low cost sort of REIT, really. It can get quite savage, as you can see there on that chart. I think, and last year as well, when we had that sell-off into June, it got savage down to the sort of $2.15 mark. It's a really good one to buy on dips because it's it's a reliable, solid business with a average WALE's 8.6 years, 99.9% occupancy. But you can see there on the 5 year.
It dips every year, doesn't it?
It dips at some stage when there's a bit of a property freak out. It's just a fantastic one to, because look, service stations, with 8.6 average WALE, and essentially, one customer being Viva, they're very stable. There's no lease renewals until 2025, I don't believe, so at all. So we've still, so it's a great one where, when the REITs catch, sneeze and catch a cold, you can just got to step in and buy this one because it down at that $2.10 level, it will be yielding up to 8 or 9% plus sometimes.
Wow.
So, and look, everyone needs fuel for their cars and things like that. It's a pretty essential service to have those service stations. So it's fairly safe to head into this one. So I wouldn't probably look, if you've got it, hold it. But it'd be one of those ones that if we have a bit of a freak out next year at some stage, or
so if it gets down to $2.10,
somewhere around there, I would be looking at it again, potentially. So. It's a pretty reliable play. We've rolled this around probably 2 or 3 times in the last 2 or 3 years. We never really have. The risk is buying it too early, basically. So it can get quite thin and nasty. But if you sort of pick your levels and know where you want with your yield, it's pretty good. So,
Claude, what do you think of Waypoint?
I think that amongst the REITs available, it's one of the better ones, basically because it's a bit of it's a bit different from, say, the office tower REITs that I wouldn't favour. In terms of this particular one, look, I think if we look at the past dividends of 16 cents per year, and according to analysts, it's going to maybe go up a tiny bit, but not much. That's how I'd kind of look at the return you're getting. That's about 6.4%. Unfranked dividend there, so that's sort of comparable really to money in the bank account. Now at the moment I'm getting 4.75% in the bank account risk-free, and so I don't think, for me personally, it would be enough to just take on any kind of risk really for such a slim upside in terms of the yield. So if I am occasionally can be seduced by a dividend stock, right now these days I'm not that easily seduced by a dividend stock that 6.4% no franking would do it for me. So just for that reason, I call it a hold, and it's not one I'd be buying. Despite the fact that it's all right, really, I'm not against it either.
But a bit like Mark said, if it got up to a 9% yield, if it pulled back to $2.10, then it's probably worth a look.
Yeah, absolutely. And you
absolutely.
You got to think about it as well. If you're getting that 4.75 in the bank, like there's no brokerage on that either. So you got to add up all your costs and get you, because it's we've really gone nowhere in about 3 years. If you now you've got that yield there. If you can snipe from the sidelines and pick up, you don't have to roll the dice and take risk any longer. So you can be a little bit more selective now with those yields.
All right.